What? Michael Burry is shorting Tesla? When he's buying a ton of put shares? Why is he doing this? Okay, calm down. Maybe there's some. What? Tesla's recalling 300,000 cars in China? Oh my God. What the hell? What? What? Sales are down in China for Tesla? Okay, man, I gotta sell this stock. I gotta lock in my profits. There, done. Just joking, as if I would ever sell my Tesla shares. No way. Hey everyone, in today's video, I want to cover the common reasons why people sell their stock. And I think you like this one. I'm going to share my exact process for knowing when to sell a stock. As I'm sharing the common reasons why people sell their stock and you're like, ooh, I'm guilty of that. That's okay. I've been in that camp. And in fact, it's actually costed me a ton of money, like in the 6 figures, okay? I just hope that by sharing this, that I help you course correct in your journey or save you a ton of moolah or mitigate your mistakes, because you know what? All of us are going to make mistakes, but the key is to learn from them. But at the same time, I'm going to share my exact process for knowing when to sell a stock. And this has made me hundreds of thousands of dollars because I found better uses for the money. Now, before I share my exact process of knowing when to exactly sell a stock, I'm going to share the common reasons why people sell their shares. The first reason is panic selling. So you're like, whoa, okay, you're looking at your stock app and you're like, whoa, everything's red. And then you hear the news, you're like, whoa, COVID is coming. Or you're like, what? Oil is crashing. You look at your charts, you look at your ticker symbols, you look at your companies and you're like, everything is plummeting. And you're like, I gotta sell, I gotta sell. I hate to say it, but that is a big no, okay? Remember, why did you invest in the company in the first place? Say if you bought some stocks, like a very popular stock like Apple, and you are literally owning a tiny, tiny, tiny slice of a company. You own a tiny slice of the company. Do you think the company is going to grow, get bigger, make more money in 5 years from now? So you gotta think, what is the reason for you selling? Is it because you just got scared? But in reality, you gotta think, do you think the company is going to do well in the next 5 years? What was your reason for investing in the first place? Because you literally own a tiny slice of the company. Why would you sell a company that makes money? It's like saying, hey, Venus Williams, the famous tennis player, oh man, she's won too many games. I gotta bench her because she's won too many games. It's like, why would you do that? She's still winning games. That's like what you're doing when you're selling a stock and you're like, I want to lock in profits. Why would you do that if it's going to make even more money in the future? Think about that. Now, the second most common reason for selling is, oh, the stock has done nothing for years. And I think the best way to explain this is through an example. Okay, so you buy a stock and when you bought it, you're kind of like, been probably looking at the charts and it's kind of going like this and you bought it like maybe here, okay? And then all of a sudden, for a long, long time, it just keeps doing this, okay? It's trading in a range. It's called consolidation, okay? I'm super guilty of this where I'm like, oh my gosh, it's been consolidating for like 3+ years, okay? You know what's a great example of this? Amazon, okay? I say the bigger the spring and if it's a quality company, okay, this is like a spring. The bigger the spring, the longer the spring goes upside or the bigger the downside. And well, Amazon, well, you can see that it's kind of gone like that, okay? It's gone up. Up, 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 up. So your job as an investor is to always evaluate the company's performance. Is it growing its revenue? Is it growing its net income? Is it growing its cash flow? Is it going to grow, grow, grow and make a lot of dough in the future? That's what you need to ask yourself instead of looking at a chart and just thinking of this as just numbers and a ticker symbol, because that doesn't mean anything. I bet you in the long run, in the very, very long run, the stock market will recognize this company. If it's growing, growing, growing and making a lot of dough, it will recognize it. Number 3, which is bad news, okay? I remember the time 2014, there's a lot of news like iPhone sales are slowing down. It's, the hardware business for Apple is going to be like this. They're going to struggle with their profit margins. So guess what? The stock was actually dropping. And the PE ratio back then was so cheap. It was like between 9 and 11. It was so undervalued. But if you just read the news and followed the news, you would have sold all your Apple shares. And I could tell you, that's a big fat mistake, obviously, because Apple is more than just a hardware business. They sell a lot of services and software. So all I'm trying to get at is, look, you gotta do your own research, do your own due diligence, check out their financials, really get to know the company. Same with Tesla. There is tons of bad news about Tesla because that's how people read the news. That's how they get eyeballs. News want eyeballs. They will come up with clickbaity titles. So the news will say, hey, there's a 300,000 cars being recalled for Tesla. When you actually just know a little bit about Tesla, you find out that those 300,000 cars that are being recalled in China is actually just a software update. They did the update. It took just 2 minutes. That was the recall. But you could get scared and you could say, oh no, Tesla stock is going to go down, or there's this big whale that's trying to short Tesla and buying a lot of puts on Tesla. Just please do your own due diligence. Make sure you check and ask yourself, is the company going to grow, meaning its revenues, cash flows, earnings? Is it going to make a lot of dough? Is it going to have good profit margins? Is the company going to be different in 5 years in a big way from compared to today? Look at it as a gift when there's a dip, an opportunity when the stock goes down for you to actually buy more shares of a company that you love and has great financials and is a quality company. Number 4, okay, this is selling your winners. Okay, this is, okay, I'm so guilty of this one. I've done this numerous times. A great way to share this is through an example, okay? How many times have you bought a company long time ago? Let's just pick any company. Let's just say I bought Lululemon, I bought Chipotle near initial public offering. So you buy the stock and it does something like this, okay? And you're like, huh, it's gone up really fast. So it happened within like 1 year. Okay, you bought it at this price, and then when you sold it right here, right? Okay, because it doubled. It had 100% profit, like it doubled within the year, and then you decide to sell. But then you realize, holy crap, if you looked and stayed with the company, if you stayed with this company, it's done this, okay? You've given up, okay? You went and sold the company for 100% profit, but actually became a multi-bagger, okay? Notorious. I'm so bad for this, okay? I made a lot of those mistakes. This rule alone, my stupid rule for selling when the stock doubles, because I treated it like a ticker symbol and just wanted to lock in my profits, okay, has costed me hundreds of thousands of dollars, okay? I used to own Microsoft, Lululemon, Chipotle, back when these shares were less than $25 per share. So let's just say it costed me a ton of money. Okay, even 5 years ago, I sold 50% of my Apple shares because I want to recapture the principal and what they say, let your winners run, capture your principal. There's no downside because you're just letting your money run. But in reality, if I kept the entire position, I would have made a ton more money than I am making right now. Well, I can tell you, if you try to time the market, like essentially buy in the low, sell in the high, buy the low again, sell the high, and keep doing that over and over again, and you do this with high quality companies that grows and makes a lot of dough, in the end, you will make a lot less money in the long run. Now, there's this book called 100 to 1 by Thomas Phelps. And in this book, he actually tracked the records of these companies that actually went on to become multi-baggers, okay? And there was a lot of them in the last 100 years. And in this book, he pushes on, when you buy a stock, you are buying a tiny slice of a company. If the company continues to innovate and grow the revenues and produce more products and know how to make more money, has a great return on invested capital over the long run, over the next 20 to 40 years, many of these companies go on to become multi-baggers. Maybe it's not exactly 100x, you can't, because that's probably really hard to choose from like thousands of stocks, but I'm just trying to get at, you hold on to a quality company, why sell it early just to lock in your profits? Unless you have really good reasons, and this is what I'm going to get to in the next bit. Now, here's my exact process for knowing when to sell my shares. And this process is nothing new. It's the likes of Peter Lynch, Thomas Phelps, First reason, bankruptcy, okay? If the company is at the brink of bankruptcy, that's a good reason to sell. Number two, I think a lot of people could probably relate to it, especially since there's been a lot of hypey stocks last year where like basically if you own, if you owned an EV stock last year, it would have just done well. So just remember though, what's behind the stock? Like what kind of product is it? So number two, if the company is a fraud, okay, what I mean by that is that they have no product, they have very little revenue, they really have nothing to show for the company. That's fraud, okay? I'm just thinking of the company Nicola. Okay, I'm going to pronounce that wrong. I always pronounce that wrong. I actually don't know how to pronounce it at all. Where basically it had no product and the guy is a fraud who manages the company. Number three, your growth thesis, like your reasons for investing in this company, because obviously the company's growing, growing, growing and making a lot of dough. Well, number three, your growth thesis is no longer true. It's like, no, it's not making any sense anymore. So basically what you're saying is that through your research, you're finding that actually revenues are not growing as fast or not growing the way you expect it to perform. You had performance expectations for this company and it's no longer meeting the performance expectations. Maybe management sucks. Maybe the return invested capital is super, super low. Maybe the profit margins are just not quite there. What are your reasons for investing in the first place? And if that thesis, if your growth thesis is no longer true, that might be a great reason to sell. Number four, this is probably related to number three, but I'm going to just say the financials are terrible. Okay, the financials are terrible, okay, meaning that it's acquiring more debt, or worse, they're using their debt to pay out their dividends. And eventually the performance is going to go down the toilet. I know how this feels, okay? Sometimes you are fear of missing out, you go buy a company, you have no idea because it's a stock tip from your friends and family, whatever. And then when you actually start doing a little bit research, you're like, holy crap, this is not a company I would have actually invested in. And it's kind of like, it's hard because you don't want to sell it at a loss. And you're like, ooh, but you know what? You got to rip the Band-Aid, okay? Just rip it. Practically speaking, not all of your companies, all your stocks are going to be winners. There are going to be losers. Not every growth thesis, no matter how much research you do, there's going to be some companies that are just not going to make the cut. And they're going to show it over the years and you're just going to have to cut your losses. I know it sucks. I've done this countless of times. It hurts every single time. But you need to think of the velocity of your money. Do you want to continue to water your weeds or do you want to water your flowers? I can tell you, every time I sold a loser and then found a winner, meaning a better investment for the same amount of money, has worked wonders for me. Not only, of course, it financially did a lot better, but it was just like, I didn't have to worry about it anymore. I could sleep well at night knowing that I invested in a quality company. Now, my last reason, I'm going to just erase this because we need some more room. Okay, number five is you actually have another investment to make. Okay, so sometimes there's gonna be a time where you just need the money to invest in a rental property. It's okay to sell your stocks if you plan to reinvest it into a much more productive asset, something that's gonna make you even more money and increase the velocity of your money. Basically, you're making your money work harder. But please, only sell if you actually have uses for that money for a productive asset, and cash does not count. Bottom line, I'll leave this to you. In the end, it's really hard to watch the stock market, okay? The stocks are, I know, ticker symbols that have stock charts that go up and down, up and down. It goes up 5%, it goes down 2%. It goes up 6%, it goes down 10%. It is volatile, okay? The stock market always goes up and down, but that's how the stock market behaves. Just remember, every time you invest in a stock, you are actually a shareholder of the company, a tiny, tiny shareholder of the company. You actually own a tiny slice of the business. If you think the company is going to be a much bigger company 5 years from now, meaning it's going to grow, grow, grow and make a lot of dough, meaning it's growing revenue, cash flow, earnings, it's going to have growing profit margins, has a great return on invested capital. So why worry about the quarterly volatility, about the performance over the next 2 months or 3 months? It doesn't matter. If you buy a quality company, you just got to take a step out and zoom out. because the stock charts over the long term for a quality company looks like this. Okay? Okay, there's always up, there's always down, there's always ups and there's downs, but in the long term, it does this. If you buy a quality company with great fundamentals that's growing, 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 and making a lot of dough. When in doubt, just zoom out and look at the bigger picture. And if you don't have an investment reason to sell, don't sell. Hey everyone, while you're waiting for next week's video, you might want to check out this playlist over here or this video up here if you want to learn more about investing in stocks and real estate and grow your income, build your wealth, and, well, design your ideal life.